Howdy, I'm Craig Wheeler. I used to work for Bank of America for about 10 years. I'm sure some of you guys are currently part of the evil empire over there. I have since escaped about 3 years ago with Grant Thornton now. We're the fifth largest public accounting firm in the world, although I'm not an accountant, and we're probably the largest business you've never heard of. That's what I usually say about our brand presence, and I'm thrilled to be here working with Jason.
Awesome. So my background, worked at Bank of America. I put my time in the militia as well, in their global information security practice. Joined Skookum as a product strategist, and now lead the financial services arm of our digital advisory practice here. And so today, really interactive. Please ask questions as they come up. We want this to be more conversational. Working at Skookum, I've sat through enough of these where we're not going to take you right up till 1 o'clock today. And we have a lot of bankers in the room. You probably have a 1 o'clock call today you need to get to. So today, we're going to focus on some different aspects of the customer experience. So we're not going to tell you how to do a new journey map or how to rebuild your personas. We're going to talk about making customer experience work, really from the organizational perspective of making it work better within the bank. So why should you care about customer experience in financial services? Craig and we talked about it, we see 4 things really pressuring the financial services world right now. And so we're going to walk through each of these and why it's important and why customer experience flows out of these needs. So Craig?
You bet. So I think the first one obviously is around regulatory pressure. And regulatory pressure can either be an opportunity or a curse. It really depends on how you take it. One thing that we're going to go into some depth today is Department of Labor fiduciary rule. And I know some of you guys I talked to beforehand, this is kind of near and dear to you. Other folks, it's probably a little bit more out there. But what DOL is, this is an expansion of what constitutes fiduciary investment advice. It's covering basically any financial professional that offers investment advice on retirement accounts, forces some transparency in fees, and also really, when you think about what a fiduciary is, it forces these folks to go beyond offering suitable advice to offering advice that's truly in the best needs of their customer. Now, if you think about that, that can have a lot of implications in that business, and we'll spend some time on it a little bit later today. Another element that we talk about is around the commoditization of products. You can see a lot of this in mortgage. Everyone offers the same general set of products. This is largely driven by the regulations, what people will buy on the secondary market, but banks who used to be able to differentiate in their product types now are pretty much all selling the same stuff.
Yeah, and the regulation is really interesting because it limits not only what you have to tell people, but what you're allowed to tell people and how you can communicate with them. So, every time I get an email from my broker, it's, hey, log into this site, you can contact me here. You have to go and log in and read my email versus just getting an email or a text. So, regulatory really dictates what we can do within customer experience, but we don't want that to mean that you don't try to go after customer experience still. A couple of the digital trends that we've seen, other than the ones we usually talk about, going mobile, that are really changing the expectations from a digital perspective. The first one, voice of the customer, and I've got the V in quotations here. A lot of times we think about voice of the customer as something we have to go get from them. Nowadays, with the way they're able to give feedback, it's something we get whether we want it or not. A single bad review can sink a bank branch somewhere locally. It's not classic communication channels. It might be on Google, it might be on Yelp, something you have no control over. People going in social media, things going viral very quickly. So that's a key digital trend we're watching out for. Research, 70% of consumers research online before making a product decision, and 41% of those read reviews. So a little bit different than the days of kind of going into your local bank branch, working with someone there to make a decision.
What is very interesting, though, on this research piece, although we're seeing people really wanting to do more and more research online, Joe American public still wants to do business face-to-face on things they're not necessarily comfortable with. On products that require advice, for example, in the small business set, we're seeing, absolutely right, consistent with you, over 70% are doing a lot of research online, but then to fulfill the product, 65% of them go into the branch.
So the third thing is really this drive towards simplicity. It's no longer a badge of honor for non-millennials to say that they don't understand a technology. And so, it used to be, I don't get that technology. I don't understand why I have to go online. Everyone's grandma's on Facebook. My mom is Venmoing me money now and taking Ubers places. And so the expectation is if they can use these hip products and feel like they are technology forward, that they need to be able to log in and understand their banking site very easily. And the last one is the personalization journey. There's a commercial out, I forget whose it is right now, but it's got people with different net worths around their neck. So the $50,000 person is always being passed over by people with greater net worth. And the message there is everyone wants to feel special, whether you've got $10,000 in the bank or $1 million in the bank. And there's an expectation from consumers, not only that they want to feel special in their individual product, but they expect their bank to know them. So if I've been banking with you for 10 years and I go to get a mortgage, it shouldn't feel like every other mortgage site. There should be things that I'm able to pull over that you understand about me already. If I'm opening a brokerage account, you should understand how much money I have in the bank to give me better advice than anyone else would.
And last time I got a mortgage, I was still having to, well, I got a mortgage with the bank, my regular bank, I was still having to give them statements from other businesses that fell under their umbrella. So granted, that was a number of years ago, but you can see just how far behind they were in terms of what this know your customer, know your business. I shouldn't have to give you my brokerage statement when you're under the same holding company. It should be much simpler.
Yeah, and actually that brings us to a good question. So how many people here would say that their credit card, their mortgage, their bank, their brokerage account are all with a single financial services company today? So 2 people. And so the history of the word financial services in the late 80s and 90s, when you had commercial investment banks coming together, the idea was that you would go to one place in the future for all of your financial product needs. That's where everyone said the market was going. And so that's what the word means. And we're still calling these companies financial services companies, even though no one in this room is using one company to do that. And most people don't even think about their own bank when they're going to get a mortgage. They go price shop somewhere else.
And so for those of us who work with or work for one of the big banks, we all know that even though it's been a little tarnished in the news lately, products per relationship is a key driver of customer profitability as well as customer delight. And it's so much cheaper to sell an additional product to a customer than try and acquire a new customer. Like if I asked how many people here would leave your current banking relationship, say switch banks for $100, who would? 200. All right, 500. Okay, I'm still under half the room for $500. That's what customer acquisition is at these companies. It's incredible.
And so the fourth force is fintech adoption. And this was a study done by Deal Sunny about main fintech adoption drivers, so why people are using them. 44% of people said just because it's easy to open an account, they'd rather go to a fintech product than something else. 15% said it was lower cost, 13% access to products, 11% better online experience. And so these are some of the things you're competing against around why consumers are going to other products than your existing products. So, fintech companies, they're able to do, it's called disintermediation, where to get money to Craig, I no longer have to send it to Wells Fargo or Bank of America and then send it to Craig. I send money to Craig. Craig can then lend me money, and we have a contractual agreement. And so we're able to cut out the middleman, and these companies, they do one thing well. And so they do have that customer centricity and that customer focus. So those are the 4 main drivers about why we think you should care about customer experience in financial services.
And here in Charlotte, we are seeing an increased growth in kind of the fintech industry. We've got the QC Fintech Incubator over at Packard Place. They're accelerating. More and more of our employers are becoming sponsors there. So the talent and the innovation in this town is lifting. Another thing, like, why should we care? Well, I work for an accounting firm, so of course I'm going to go to the numbers, or my peers would be quite upset. 99% of banks say that customer engagement, which I know isn't the exact same thing as CX, I mean, one leads to the other, it's either important or extremely important to the success of their business. Now, even though they say that, they're not great at it. But if you look at, say, revenue per customer from engaged customers, on a regular banking customer, so Joe Public, that revenue is an additional, if he's engaged or she is engaged, additional $402 annually from that customer. If it's a mass affluent customer, which is often the big target of most of the big banks here in the room, it's an additional $869 annually, just from making sure that they're engaged and find their products and find the way you serve your customers to be attractive and get you plugged in. These numbers are from a Gallup survey that's a little bit aged now, I think 2014, but still very relevant today.
Yeah. So a little bit now why this isn't working today. So we know we can all agree customer experience is important. The way that we've seen customer experience done at financial services companies today is a little bit about the parable of the elephant and the blind men. So if you're not familiar with this, it's 6 blind men are trying to figure out what a large object is. And they each grab a different part of the elephant. So one guy's got the tail and he thinks he has a rope. One guy, he puts his hand up against the leg and it's a tree. Someone grabs the tusk, it's a spear. And it's not too great of a leap of the imagination to just put the different lines of business of your company in financial services up here and say that the branch has one vision of what your customer is. The marketing group, they've got their great customer personas that they spent a lot of money on, and they understand their target segments and what they're working in. And then the call center has their complaints that they're filing for regulatory purposes, and they have their vision of customer experience. But in the work I've done, rarely do I see someone in digital with a great relationship with someone in the call center who is getting that feedback constantly and able to act on it. Someone in the branches having a great relationship with the folks in digital and saying, hey, these are the conversations that our tellers are having. This is the way that our people talk about brokerage and robo-advisor. It's, digital kind of carves out their own little piece of the world. And so this is the problem as we see it today.
And how many of you guys say your firm says, oh, we have a single view of the customer? Back in 2002, we were working on that. Conversations I've been having with big banks, they're still working on that. What they have is deposits view of the customer, cards view of the customer, mortgages view of the customer. And if you call into one call center and authenticate there, they may not be able to help you with another product. It's like dealing with 5, 6 separate companies when to the consumer, bank is just one.
Yeah. So, what can we do about this? And it's not easy. We're going to put 4 steps up here, which make it seem like, oh, there's 4 steps to be successful. This is a very difficult thing, and it's going to take a lot of work internally, and it's definitely something that has to start small. So 4 things we thought, what are things people can take away today and think about and try to put in place in their organization? The first thing is aligning digital outcomes to business outcomes. A lot of times, we go into a digital organization and it sounds like they're trying to win a popularity contest. So, hey, we have all these site visitors, we have all these unique views, our app has logins and daily active users, and they take that to the business side of the house, and the business side of the house, won't fund their projects because there's no connection between how they're measuring the popularity of their site to actual business revenue. And so I've got 4 different types of business outcome metrics up here. So the bottom 2, brand engagement and influence response. They're very important to measuring the success of digital, but unless your financial services company makes a lot of money off of advertisement revenue and click through to different ads, which I don't think is a popular model right now for financial services companies, it's going to be hard to get a lot of business driver behind that. And so what we want to do is connect these bottom 2, people downloading the content, using our tools, to these top 2 ideas. Sales and marketing, so this is how we do conversion, the revenue per customer, and prospecting cost. If you can tie that back to that, now we have a real business conversation. And then the be-all, end-all is customer understanding. Rarely do I see a financial services company that can name their customer acquisition cost for each product line. They know their lifetime customer value across multiple product lines. If you start using terms like share of wallet with your digital outcomes, people are really going to start taking notice of what you're doing if you can show that, hey, we've expanded share of wallet because of this digital tool that we implemented. And Craig's got a really cool example where they were able to do this and,
Sure.
and how they tied the CX to the business outcomes.
That's it. So what you see here is your general mortgage life cycle, so to speak. We're not full life cycle, but just the customer journey of mortgage acquisition. And you'll see we've got our happy customer out here in awareness. They're out shopping for homes. This is pleasant. They need to get pre-approved for the mortgage. So they go into their branch or they reach out to someone at their mortgage company. They're not available. Can't find the right person. They need that pre-approval to get started. You can see this is not a real happy person. So they get through that stage and they go back into it and they find that home of their dreams. Now when you find that home of your dreams, you want to be able to capitalize on that opportunity. Charlotte, especially right now, is a very competitive real estate market. You want to get your financing done. You want to go back to your original branch? Well, what if that, say, mortgage specialist or your account executive that you were calling isn't available? How can you get that financing done on time? These are leakage points. People are apt to leak out of your process and go to someone else. Finally, you've got the paperwork, got the approval, they can get the home, and we have to go through fulfillment. And anyone's gone through mortgage fulfillment, it is doc intensive. For for many places, if you're working with the branch, you now can't work with the branch. You've got to deal with someone over the phone and whatever doc portal they may have. It's not necessarily pleasant. So what we did, we worked with, actually this one was with Cisco Systems to put in a virtual advisor or remote advisor in branch. This did a number of things. From a customer perspective, it drove up availability, because if you've got a whole set of mortgage advisors sitting in a call center type environment, they can serve multiple branches. You can really improve the availability of your people. So you can take care of that immediate service leakage point. Secondly, again, there's no need to set an appointment. You've got people who are there, they're ready to go, and can take care of those ideas. And third, because we were able to integrate it with the infrastructure of the branch, we were able to do the document collection right there. And you could even you'd be sitting on one side of the screen with your customer on the other. You'd send a document over, the customer they'd print it in branch, teller with a notary would bring it over to them, they could sign, and we were able to complete the transactions right there. It was excellent. So from a customer experience standpoint, the three big things that were important to, say, a general branch mortgage customer, which I know is different than the folks in this room, because I doubt any of you guys have gone into a bank branch for a mortgage, but we nailed availability, we nailed them to the ability to get advice. This is one of those high advice products for a lot of people that aren't comfortable necessarily doing it all on their own. And third, we really cranked up that cycle time because we were able to get rid of the leakage points. And if we link this to business outcomes, you think about it, a specialist is not a cheap person. So we went from having to have a person in a branch who may have idle time, and if they're not staffed, say during peak hours, those leakage points don't exist. We were able to support multiple branches with a person, so it really drove down cost to deliver. We improved the productivity of each of the individual salespeople because, A, they were far more available. And then finally, if you think about this interaction, well, in a call center environment or a video environment, you can tape, you can measure, you can store the data, do keyword searches, you can understand what's happening in these interactions. A one-to-one conversation, you don't know what people are saying or what they're doing. You like to try, you like to train around it, but you just don't know. So this actually adds a great regulatory compliance benefit. And if we hit the next page, you can see some of the examples of where we've worked on this around the world. The center one is what I'm talking about right now. We increased customer sat about 10% plus in post-interaction, but the big bang was 29% increase in units of sales. That's enormous. Another one that is, I think, very interesting is this large Australian bank. By putting in video, we were able to go to a #1 ranking in their market in Net Promoter Score. And the business outcome, and this is huge. So we talked a little bit earlier about cross-selling, driving loyalty, et cetera. They went from a 1.8 products per, say, new customer interaction to 4.5. And then finally, of course, you can see it's similar as a UK mortgage company. We're #1 in the customer sat rankings and actually increased their overall revenue by 66%.
Awesome. So step one, align digital to business outcomes. Easier said than done. I think there's probably a whole talk we could do just around tying NPS back to business outcomes.
Yep.
The second thing we want to do after we've done that is we have to start crossing those channels and building consensus around the importance of customer centricity. My girlfriend loved how many elephants were in my slide deck. That was her #1 thing when I rehearsed this with her. So, this is much easier said than done. Anyone who's worked in a big bank, it's not easy to go across channels. One great case study where we were able to do this for a client, we had a client where we were rebuilding their self-directed brokerage enrollment process. So on the first page of this process for enrolling, they had a 93% attrition rate. And they said, how can we improve this attrition rate? And we said, well, how are people getting here before this? And they said, oh, well, those are a bunch of marketing pages, but we don't own those. And we said, well, let's get marketing to the table. And we said, well, where are people going after this? And they said, oh, that's an ops problem. And we said, well, let's bring ops to the table. So rather than just starting to redesign the process, we did a big offsite workshop. We had actual users go through the entire process to end, and made those three partners sit and watch what people were saying about their whole end-to-end process. And then the conversation just flowed to, well, we have these problems, and we created that cross-channel ability to start working together. So I really like that case study as, bring the user standpoint in, get those people in a room, and don't have it be, we need this from you, you need that from us. A lot of times it's, marketing says, hey, we got the people to the homepage, we've done our job. It's not our fault that they're not clicking into your tool because your information architecture is broken. And then digital says, hey, we got people onboarded, it's not our fault, they're not funding the account, that's an ops problem. And so, start having conversations about the quality of the marketing leads, the quality of the enrollment experience to getting people to adoption, and show people how those digital outcomes can tie to business outcomes.
There are some regulatory pieces that play in very well here too. The CFPB says that you've got to bring in complaints, analyze them, address them, then aggregate them and perform root cause analysis ostensibly to fix whatever's going wrong in your business. A lot of banks and a lot of companies, they'll do this, but it's done to meet the letter of the law versus how do you take this? You've got these customers who are telling you their pain points. They're telling you exactly, this is how you're hurting me. One bank I'm working with currently will look at a complaint, define a complaint as anything regulatory that could have a regulatory implication. If it doesn't have a regulatory implication, they call it a service complaint, and they don't bother to track that. But if they harnessed that data and brought that in, aggregated it, and worked on it, you're hearing about the true pain points in your process. You're able to really improve and markedly move your business forward. Another piece I've seen this, so just a complete lack of integration, is social media scanning. These companies, they'll invest a ton of money in these great social media command centers, et cetera, and they will produce beautiful reports about sentiment, what's being mentioned, what's happening, where are you this week in positive mentions versus last week, and specifically what were the kind of the key verbatims. I was a business user of these over at Bank of America when I was in default servicing. I'd look at it, yes, this is great, outstanding, and then I'd set it down. Where's the linkage from that into the strategic planning process, into, even more importantly, your operational risk and your reputational risk departments? Those should be key risk indicators, but at this point, that's living in marketing, giving it to the LOB, and that's where it stops.
Yeah. So, start to see, the whole customer here rather than the pieces. Step 3, so we've aligned to the business, we've started across channels and built consensus around the importance here. We want you to flip the enterprise org chart. So today, an executive comes in, they get their yearly voice of the customer study done where they come up with their strategic plan of the markets they're going to target. They pass that vision down to the managers come back with a budget request for how they're going to meet those needs. And eventually the end employees who are going to implement this have their goals for the year. Now a lot of employees at these digital organizations, they have the latest usability study tools. They're getting the voice of the customer, and the voice of the customer isn't a yearly thing you can track. It's not a tactical, we know the customer, let's put it in the box and use those insights. But what we see is these employees that are closest to the customers don't have the voice in the organization or the flexibility in the executive plan to act on those insights. And so it's something that has to come from the top down, but I think employees can start pushing on it as well. And if we start to think of the org chart like this, where instead of each employee group having their different customer insights, we have a vision of the customer at the top of the organization, and the employees are the next line down from that because they're closest to the customers. And I read something in an article that said, stop being a B2C company and be a C2B company, where your customers are driving what your business product is. And then those employees end up working with the managers, and the managers have to have a service mentality where they're no longer serving the executive vision they're working on for the year. They're serving their employees who have those insights. Now, it's very easy to stand up here and say that, but knowing that the internal politics is not going to allow for this immediately, it has to almost start at that manager level because they're going to have the requirements coming down from their executives. They're going to have the employees in their ear with what should be done. And so it's their ability to triage that and bring the flexibility to that strategic plan that we see as the key third step here.
I think this is very impactful because I've not seen a financial services institution that does this well yet. What's interesting in my industry, in the advisory business, because the way we do work and that we're pushing work down to our associates who then have that primary point of contact with the customer, it's very imperative on me as a senior manager to enable them to work, to be there to answer questions, take advice, and stay in touch with them so they can do their jobs. And then my job is then to work with our executive, AKA a partner or managing director, to inform them about this is what's happening, this is what we need, this is where we're going with it. Because they're the closest to the front end, they're the closest to the sticking point. And if you can give them a voice, it's very effective in delivering the work.
So the fourth thing that, which I think is actually the easiest one, so we saved an easy one for the last, is communicate. And we mean really communicate back to the customer. So, this is kind of an abstraction. 95% of companies, they're collecting feedback. 50% maybe alert their staff to that feedback. 30%, 40% maybe use those insights. 10 to 20% deploy and improve. But even those that deploy and improve, no one tells the customers that they've done it. And so whenever we do a competitive benchmarking of a site, one thing I like to do is I like to look for how many times they use the word you and your on the site versus we and us and our. And I calculate that as a ratio to how customer-centric they are. And do they spend time bragging about their awesome products and the great features and their cost, or do they talk about the customer's goals, the customer's needs? Go back, do it on your own sites, on your own product pages, and see how much you're talking about yourself versus talking about the customers. And it's fascinating. And if you look at some of the companies that have done really good site revamps lately, or the fintech companies, you'll see a very different ratio than what you see at a lot of the big companies. And so just tell your customers, tell them what you've done. They know that you're listening to them in some form, and it's not hard in your next email that goes out to say, hey, look at our great new portal versus, hey, we heard that you wanted these features. They're in our new portal release. And Craig's got an example, and I actually got an email yesterday of a bank doing this. So I'll talk about that one too.
Sure. So I put my favorite example up here first, which is about Tesla. A Tesla driver tweeted to Elon Musk that people in the San Mateo Supercharger were just using it as a parking lot. They'd park, hook up the charger, and walk away, and in essence get prime parking all day long because they were there first. He was saying, hey, this is wrong. We can never get there. So Elon, being Elon, tweets right back to him, you know what, this is an issue, this is for charging, we're going to take action. Now, you get down to it, if you look under the covers here, he actually had, because they're good at listening to their customers, he was already into this and building the capability to create a warning system to warn people that their cars had been parked too long and they needed to move on. But it created to the public customer, the public-facing customer, I mean, look at it's incredible, but he was able to give the impression that you asked, I listened, and close the loop and it looked like 6 weeks. And all you guys are in technology, actually accomplishing something like that in 6 weeks is astounding, but he gave that impression. Now banks can do this too, and they don't do it in a big way yet, but when I was with Bank of America, I worked in default servicing in short sale and foreclosure. My job, it's the dumbest job title of all time, I was voice of the realtor, which meant my job was to work with realtors who are absolutely critical to making the business work in the short sale or foreclosure environment. Because if a realtor wants to make an offer on a home in a short sale environment and they think, oh, don't want to work with Bank of America, they're terrible to deal with, we'll never get it done. They won't. And so your homes will languish, they'll move into foreclosure, which is something no bank, contrary to popular belief, no bank wanted to do that. It was just killed you from a financial standpoint. So my job was to reach out to realtors via surveys. I did focus groups. I led 2 or 3 roundtables, collect all the things that they said they cared about. And then we would filter that into our change process to make these fundamental changes in the process. Now, because their opinion of us was so critical and they were so loud, I say loud, I mean, if you, back then in 2012, you looked on YouTube or anywhere, they were all just constantly just blaring feedback to you about how bad you were. If you came back to these folks and said, you asked, we listened. You said that the doc collection process was unwieldy and you were asking for docs too early, and we listened, we need these 3 docs up front, then we're going to kick this ball off and get the thing running, and over this other process that you can give me the non-essential stuff, because I don't need this to kick off the process. Or on valuations, you said our valuation reconsideration process was kludgy and a pain and almost impossible to get a bad valuation challenged. Well, here's our new process. You're going to talk to this person. He is your single point of contact. They will initiate a revaluation. We commit to you. We can do it in 6 business days. So by doing that, we went from being the absolute whipping boy of the default servicing space to towards, say, that was in 2009. By the time 2012 rolled around, we were hearing different voices, right? Yeah, Bank of America has really improved. What they've done with Equator is outstanding. It means a lot to us. So we had to go back out to them and tell them that we listened to you in order to move that needle.
Awesome. So I think that wraps it up for us. This is just a starting point. There's a lot about kind of moving to a more strategic view of customers and tactical. But hopefully this gives people an idea of where to start. So any questions?
How do you get past, going back to the flipping the org chart,
Mm-hmm.
how do you get past that horizontal fragmentation that you often have in like these large infrastructure banks? So marketing, tech, customer service. How do you get that information from the customer to trickle down to all of these different fragments in a way where they're actually doing something that makes sense?
Yeah, I mean, for me, I think getting people to the table as early as possible in the process is a big part of it. So a lot of times, I see clients, they go to those partners once they have the requirements and the solution, and the design's already done. And now it becomes a territory game of like, well, I appreciate that, but you're kind of doing my job. We already had this project going. So, getting people to start, when you're building the journey map up front. And one thing I love to do, kind of journey maps it's a love-hate thing where sometimes they end up as more of a brainstorm and a brain dump of ideas and issues than anything that's usable. What I like to do is overlay the key metrics for each line of business and who's responsible along each step of the customer journey. So during the awareness phase, it's up to brand to create awareness. This is how they're being measured. This is how that KPI ties back to the business. And in order for them to be successful with the marketing group, which is paying for search and getting people to the first page, this is what translation looks like from that group to that group, and this is what the responsibility is and what they owe them. And so now you're establishing a conversation using data and less about a territory grab for that. So I'd say, get people to the table early and then use that data to establish how things are going to flow through the process.
Another piece of that, it's all about the business case. If you can draw what you're trying to achieve, draw a very clean line from what you're trying to achieve to the KPIs and the critical dollars and cents of those line of business folks, they will be up in it. It's if it's a departure or it's difficult to explain, they're likely going to sit back. But if you can create that connection, they will sometimes be up in it more than you want them to.
And it's very hard because digital doesn't have a home right now in financial services. Sometimes it sits in IT, sometimes it sits in marketing. I've seen it as its own line of business. I've seen it sit under human capital. And it's still finding its resting place. And one of the things when we try to benchmark maturity of digital is how is the alignment to other parts of the group and how much are they working with those other stakeholders? Any other questions?
You mentioned fintech, and in some cases where that has a perceived better customer experience
Mm-hmm.
than, let's say, a large financial services firm. And so, have you seen any examples where two have come together, a fintech and a large firm, like an acquisition or something, where it's actually worked and the net result is positive, as opposed to kind of lowest common denominator?
I think we will this year. 2015 was really the year of purchasing. A lot of fintechs got bought out in 2015. It slowed down in 2016, especially with DOL. All the big players are going to be rolling their robos out, and we'll kind of see, like Bank of America used more of a build strategy versus there was a lot of acquisition, and then some other clients are doing a white labeled solution. So I think this year will be the proving point for the battle of robos. Vanguard and Schwab built their own. They're already way in front of everyone else. I think Vanguard has more assets under management than the rest of the field combined in robo right now. As far as integrating and working together, there's a lot of the very kind of the more payments is an area where I'd say it works a little bit better, where there is that integration work happening. The example I was going to give earlier is Wealthfront. So I got an email from Wealthfront yesterday. They're on the robo side, and they said, "Hey, we know we came out with this financial planning tool. We got a lot of feedback from you guys. Here's 2 new features." And so they didn't tell me, "Hey, here's these 2 new great features." They said, "Hey, this was based on what you said." And one of the things was 13,000 integrations into Wealthfront from existing banks now, making it easier to transfer for them. So, that's not a true partnership, but the fintechs are making it work on their side. I think the banks are still a little bit hesitant on some of the partnerships where they're not able to white label it.
And they're starting to get into it. I had a conversation with a risk executive at one of the big banks in town. They were asking me, what are the implications of the potential OCCs looking at chartering fintech companies, et cetera? And they're starting to think about, if they're doing that, then how does third-party vendor management work in? So at these leading banks, there is a real interest in doing so, but I think to go right with what you're saying, they're not quite sure how to make it happen just yet.
Yeah.
Yeah, what I was thinking about was the concept of branding and then the concept of customer experience as it relates to financial services. And so, as I kind of thought about it a little bit further, I said, well, there was a time where, engaging with a Bank of America or Wells Fargo, as an example, was an important consideration. But now, since there are so many new entrants into the field, as long as you can get capital, it doesn't really matter per se what the organization is. But just kind of curious of what you guys are seeing in terms of from a customer engagement perspective. How important is brand versus customer experience in today's market?
I mean, extremely important still. I think last summer, Wells Fargo took a huge hit to their brand, and it has affected what they're able to work on, what their products look like, their consumers. When the whole fake accounts thing broke, it caused a major downturn in what they were able to do. So that's just an example, but before that, Wells Fargo is the #1 global banking brand, with 2 banks out of China being number 2 and 3 as far as recognition before that. And so you can get by on brand alone very strongly. And it's actually been a big problem if you look at Wealthfront and Betterment in the robo-advisor space. So estimations for their customer acquisition cost for getting people into those products is between $300 and $1,000. Now, with their average kind of account size of $50,000, they're not able to make their lifetime value of a customer based on how much it costs to get that customer in the door. Versus, a Wells Fargo, a Bank of America, they have the name brand recognition. People know what they are, and so when they push a robo-advisor product out, they'll probably be able to do it for 1/5 the customer acquisition cost because of that awareness. So it's huge. It's a huge advantage, and that's something that the fintech companies run up against that these banks have. Their issue is leveraging it to seem like a tech-forward brand. And if you kind of think of the marketing life cycle, moving some of these fintech problems from the visionary stage to the early majority, late majority, I think that's where they'll be able to use their brand really strongly to get people in the door. So from my perspective, it's extremely important still.
So you're saying branding that is significantly higher. Well, you're saying branding is still more important than customer experience. I mean, I just look at a company like Carvana as an example, right? I mean, although they're a relatively new entrant into the marketplace, but their customer experience is much better than a dealership. And so if I'm looking to buy a car, I'm looking for the best experience possible. So even though they're a fairly new entrant, does the brand really am I really swayed based off the data that you guys are looking at from a customer perspective? Does the brand really hold more value and weight than the customer experience?
I think it depends on being consultants, we could draw you a 2x2 matrix of this,
Sure.
but
Yeah.
I think about it in terms of the complexity of the product combined with the level of investment that you're making in something. So, Uber costs you $10 to try Uber, and you get a great customer experience, you're never going back to taxis. Investing $50,000 in an ETF fund, that's a really big decision. And so, these cool hip companies are out there that people are using, but I've heard of Wells Fargo, I've heard of Bank of America. I know they're going to be around in 10 years. I don't know that Wealthfront's going to be around in 10 years, and a lot of people, might not know that right now. And so, I think for adopting PayPal, adopting Venmo, much easier than using an existing bank's money transfer system. Making a large investment or getting a mortgage, you might think twice about who you're going to go with. So I think as the complexity and the amount of the investment increases, you're going to be likely to go to an expert where that brand you recognize.
And I think sometimes we all run the risk of everybody in here, I assume, tends to be like an early adopter or out on the far forefront of trying the new thing. The mass of consumers aren't necessarily there. So what matters to us is often not what matters to, say, who is really filling the coffers of our companies.
Yeah.
But what about looking forward? Like right now, I'm not going to invest $10,000 on my Acorns app.
Right.
But a millennial who's using it now, 5 years from now, if Acorn says, hey, we do have a $10,000 product, they probably will adopt.
Yeah.
Right?
Yeah.
So, I mean, I think it's important to have, if you have that really stellar customer experience, that little investment where, yeah, maybe we're not taking you seriously right now, Acorns as like a primary investment tool, but 5 years from now, when it's been in my pocket for all this time, I probably will adopt it.
Yeah.
Right?
That's a great point.
It's the entire innovator's dilemma. You know, you've come downstream, you've capitalized on a new market with a lower cost product, and now as that market gains more power, you're able to move into a position of power. And so it can be extremely disruptive, but you know, for a large bank, getting $5,000, $10,000 clients, it's like, all right, great, they're an annoyance right now. You know, they're going to cause us to fall out of compliance with DOL because we didn't tell one of them, you know, we didn't have one of them in the right fund.
Yep.
And so that's a scary thing for them versus Robinhood. It's like, yeah, you know, Robinhood will give you, if you have $1,000 in there, they'll loan you $1,000 and let you trade on margin, which Wells Fargo would never, you know, like
Right.
a large bank would never think about doing that right now, but they're trying to get people in the door. So,
And it's, with regard to investment, you brought up a great point. I mean, right now, I'd love if there was like a continuum, but you have advice on one pole and you have education on the other, and it's very difficult. I think that's what they're all going to have to cross is that point. At what point do I shift them from self-serve and education into where I can get more money from them and provide them real, tangible, workable advice? I don't know if anyone's solved for that yet. I'm interested in it. Bill and I actually talked about that just the other day. And as smart as he is, he didn't have an answer for me. So,
So, do you think a big bank such as a Wells Fargo or a JP Morgan or Bank of America would be better off buying out the existing fintech company or building their own platform?
it's a case-by-case basis. It very much depends on the product. And I think a key component of that I've seen, you know, in 2015, people were very excited about buying fintech companies. To me, the question that remains is how those companies that purchased are going to position those companies in the market with the rest of their product portfolio. Because if they don't break down those lines of business, they might be buying a fintech company that doesn't make sense with the rest of their target market for the type of consumers they have. And so, you know, with your question earlier, when everyone comes out with their robo in April, when DOL comes out, how is everyone going to target that, and is it going to make sense with their existing target customer base?
and I think you'll see that banks are starting to realize that, like I brought it up earlier, but walk over to Packard Place and look what you've got down there. You've got brand new fintechs who are working in that building and gotten a small investment and then some discounts, and who's coaching them? They've got folks, teams from Bank of America, BB&T, coaching these companies on, hey, this is what you can do. And the reason we're doing it might seem, oh, you're coaching your competitors, but this is an innovation strategy. They're learning how these new and innovative companies think. It's a great reward for their talent to get in there and experience that. And there's a nice sharing of ideas that I think overall the industry is starting to buy into, that a good kind of genesis of ideas is lifting all ships.
So how do you integrate the digital and the customer experience with the regulatory compliance that's out there right now? I mean, because I see like the Acorns and the Robinhood, well, they don't have IRAs because DOL. You know, like they're terrified. How do they bring that into what they're doing? And how do we make it all together? Because we couldn't tweet today. Like we couldn't do what Elon Musk does and respond to a client because that's got to be, we've got to archive that with our client. So how do we integrate all that together?
Yeah.
That's exactly what we've been talking about. I mean, you and I have been talking about it. Bill and I have been talking about it. And I don't have the secret sauce yet in terms of how do you migrate someone from Robo as they grow into a kind of full service platform, and how do you make money? Because DOL puts so much fee pressure on you guys. How do you make money on someone, say, who doesn't have that portfolio? I'm actually was hoping to hear some feedback on that, because that's like what's currently on my mind.
So, where I've worked with my clients on that is, there's the letter of the law and the spirit of the law. And from what I've seen is regulatory goes through, they say this is the letter of the law, these are the closures we have to sign, these are, this is our stance on the BIC form, this is who's going to sign it, and they pass that on, and the digital group gets their new disclosures that they put on every page. Now, what if they brought in digital early and said, this is what we're trying to convey to our clients. This is the current state of this. A lot of people that aren't in financial services have no idea what DOL is, and it doesn't exist. And yes, it was on the news as something that was potentially drawn back, but most people didn't notice. A lot of consumers probably won't even notice they're signing another form for their financial advisors, but it does limit what you're able to do. So bringing digital in early and say, we're trying to educate clients on what fiduciary responsibility even is. How can we do this as part of our enrollment experience? How can we go above the letter of the law and show what that is? And so it's combining those two ideas instead, is what I'd say.
And I think there's ways to, I've seen people starting to think about using some more, I'm probably going to use the wrong word, but distributive technologies to make advising cheaper. In essence, can you do this via, rather than the old classic, I'm going to sit down across from you with my two nicely printed scenarios in my office of fine leather and rich mahogany. Rather, can I do this with let's do scenario planning dynamically together, so have a dynamic conversation leveraging technology, and then if you want to reach me, you know what, we can do a video meeting on my phone using video and drive down your costs that way. I mean, similar to what these mortgage companies we talked about earlier, the technology's grown since then. You can do that on any mobile device, and that might be some of the ways to drive down cost, to provide that education earlier in the life cycle at a fee that might be more manageable. Go ahead, Bill.
I think just the one other thought on that would be that the opportunity is in getting all the right, what you might think of from as a critical quality elements into the design process up front. And it's where maybe there's been some missed opportunity with some of these fintechs, and they've designed that one thing that's kind of narrow, and by just not having the right people at the table and thought process, they could have designed it a little bit differently to go at a broader market in a compliant way.
Yeah, I had
Thank you,
clients
Bill.
that still don't fully understand their DOL strategy that are in the digital marketing group. They know that there's a letter going out, they know that the financial advisors are doing something, but they weren't brought to the table until the last minute, and so they had no ability to even impact it.
Hey, I actually got my
Yep.
hard stop coming. So if there are any more questions for me, I can take one right now, but then I've got to go talk to another one of my not so exciting clients. But
Hopefully they're not here.
no, they wouldn't be here.
All right. Great.
All right.
Cool. Well, thank you guys.
everyone.